Hey guys, Chris from adapttuition here, and this is video number 1 in my error correction series. In this video, I'm going to be teaching you how to correct 3 types of errors that do not affect the agreement of the trial balance. Errors of omission, errors of commission, and errors of principle. There are other types of errors, but I'll be covering those in future videos. And when I do make those videos, I'm going to put a card up there and a link in the description below to carry you to that playlist. Also in the description, you are going to see timestamps that you can click on or tap on if you're on a mobile device that will carry you to specific parts of the video. So if you, for example, know you want to go straight to errors of principle, just go down to the description and click on that and you'll go right there. Or if you are on a mobile device, you can touch the screen. If you're on a laptop or a desktop, you can hover the cursor over the video and the timeline for the video will come up. And you'll see it broken up into segments, and each segment has a name that describes what is being taught in that particular chapter. So please feel free to use that to jump around the video to get to what you need to see. I also want to encourage you guys to have ready a pen or a pencil and some paper, because you should be taking notes as you go along in case you have any questions, which you can leave in the description below, as well as I'm going to be giving you some exercises, some questions to try, and then correcting them with you. Trust me guys, it's way more powerful when you take notes and when you write things out than just listening. Now don't get me wrong, listening has its place, and some people need to do that. They need to listen first and then try. So if that's what you need to do, make it work for you. But trust me, writing it out has power. And finally, I want to remind you guys that I do have a website, which is adapttuition.com, and if you put /downloads, it'll carry you to the page where you can download free resources. I have about 8 or 10 handouts there, including one covering the errors covered in this video. So those handouts are my gift to you. They are totally free of charge, and please download them and take a read of them. Okay guys, with all that said, let's get into the work. Alright guys, so in case you didn't know, we use the general journal to correct errors. And then of course we go to the T accounts and we fix the stuff there. In using the general journal and of course entering things in T accounts, you're going to need to know how to use double entry, the system of debits and credits. And I know quite a few of you are not entirely comfortable with using double entry. And I just want to reassure you that I went through that same thing when I was in Form 4 and Form 5. And every time we learned a new topic, things got a little worse. But it came to a point one day where I said, look, I need to figure this out. And I took my notes and I took the questions from the book and I tried stuff and I got stuff right and I got stuff wrong and I asked for help. Unfortunately, I had good friends and good teachers who were able to help me, and I was very much open to what they had to say. So same thing with you all. If you could talk to your friends, you could talk to your teachers, or you can talk to me in the comments below, and I will definitely try to help you guys if you don't understand something. Okay? So speaking of that, let's just take a little recap of some double entry stuff, right? Just in case it helps. So what I have here is a little table showing double entry rules for 5 items, right? And of course, as you know, double entry is called double entry because we have 2 things that we could possibly do to T accounts. We can either debit them or we can credit them. And whether that causes an increase or a decrease depends on the item. Okay, so we have assets, liabilities, capital, equity, revenues, and expenses. Of course, you see some other words there next to revenues and next to expenses. Just ignore those for now, revenues and expenses. Now, there are 2 items that follow the rules of debit to increase and credit to decrease, and those are assets and expenses. And I want you to think about it for a second. Assets are things the business owns and controls and uses to make, well, revenue and profit, that kind of stuff. And expenses and losses, well, expenses are things on which we spend money. So think about that, something on which you spend money. So like electricity, wages and salaries, rent, that kind of stuff. What about assets? Don't we spend money to buy assets? I mean, we have some stuff like cash and bank that we don't spend money to buy. That's the money we spend, right? But if you think about it, if you think about stuff like any of your non-current assets, fixtures and fittings, motor vehicles, equipment, furniture, anything of the sort, you spend money on those things. So assets and expenses are items on which, for the most part, you spend money to acquire them. And those 2 items follow these double entry rules: debit to increase and credit to decrease, right? So those are assets and expenses. Now, another way to think about it is that when you spend money on something, that's where your money is going. And for those of you who, well, I don't know if any of you all who watched the multiple choice series back in May, June, July 2020 would still be watching, especially this video, since you may be past CSEC level. I made up a little acronym or little thing: credit where it's coming from, debit where it's going, to help you remember what to credit and what to debit, right? So you can use that thing, credit where it's coming from, debit where it's going, to help you with double entry, but it does not apply in 100% of the circumstances. It applies in a lot of the basic circumstances, and yes, in some cases when we're correcting errors, but not all. All right. What is actually more powerful is learning the rules, learning how they work, and following them. Right. Now, let me actually talk about back to the table again. So we said assets and expenses. That's where money goes. So the other three things, those are the places where money comes from. Right. And you're noticing that those three items, to increase them, credits. Right. So credits will actually increase those items. What are those items? So let's talk about capital first. So capital, that's the first place that we are supposed to get money, and any business is supposed to get money. That's from the owner, right? So you credit the owner when the owner invests his or her capital, right? If the owner doesn't have enough money, we have to borrow, and any money so borrowed is referred to, or classified as rather, as a liability. So liabilities are another source of money. So money is coming from liabilities. So you credit where the money is coming from. Similarly with revenues, so revenues like sales, or if you have other revenues like rent revenue and that kind of stuff. So that's where money is coming from. So that way the business is kind of sustaining itself. It's earning its own money to be able to buy things. So the owner doesn't have to keep investing more money. The owner can actually take out some to reward him or herself for investing. And you don't have to keep borrowing money from liabilities. So revenues are also a source of money in a sense, right? So these three items, which are sources of money, follow the rule that you increase with credits and you decrease with debits. So with that in mind now, like I said, now once again, I'm not expecting you to memorize these things or perfectly understand what I'm saying the first time hearing it. You need to work at it, but this is the starting point, right? So if you want to take a pause, copy down that table, but I'm going to leave that table up because I'm going to be using it as I go through the video to kind of help you get the hang of double entry. Okay, so what I'm going to do, let's just take a quick pause here. Let me rearrange some stuff, and we're going to start the first set of stuff. Okay guys, so the first type of error we're going to take a look at is an error of omission. So to omit means to leave out. So an error of omission is simply an error where a transaction, as you can see there, was completely omitted or left out of the books. In other words, it was not recorded. So it says the simple fix for this is to record the transaction. Long story short, if it wasn't recorded, but it was supposed to be, then you have to put it in the books, right? Now, as I mentioned, this type of error does not affect the agreement of the trial balance. The reason for that is because if it was left out, it means that there's something missing on both the debit and credit side for the same amount. So if that is the case, if the debit side and credit side are both equally affected, then there's not going to be a difference between the debit and credit side. In other words, they're still going to be equal. So if we assume that this is the only error and all of the other double entry is perfectly done, the trial balance will still balance. Right? So these types of errors are picked up with your control procedures. Okay. Now, let's take a look and see what the example is saying, right? So we have an example. It says the purchase of a motor vehicle for $50,000 by check was omitted from the books, all right? So it was omitted, so we know we have an error of omission. To fix that, we have to enter this transaction in the books as it should have been entered. So what's happening in the transaction? So we're purchasing a motor vehicle. That's an asset. And if you buy an asset, it's increasing, right? And if an asset increases, we have to record that with a debit. Right now, you're going to notice, of course, I have on the right-hand side of the screen some T accounts. And I'm going to be using those to facilitate explaining the errors or helping you to visualize where the debit and the credit goes. Because sometimes, it's like in math, if you're trying to work something out in your head and it's getting foggy and stuff, right? So that's what happens a lot of times with teaching error correction. Some students prefer to see the T accounts and see the debits and credits put in them, and then we're going to, of course, write those in the general journal. Now, when you guys are doing these questions, I will only recommend that you do the general journal, especially if your question says so. I would say the T accounts, you can do that on like a scratch paper somewhere if you need to do it. Okay, so let's take a look. So let's go to the T account first, right? So if we said motor vehicle is an asset and it's increasing, we have to go on the debit side. So 50,000 should go here. We pay by check, so bank is the other account affected. Speaking of that, it says we for 50,000 by check. Now, if we pay by check, it means we paid money out of the bank. Bank is an asset, and if you pay money out of a bank account, it's decreasing. And to record a decrease in an asset, you have to credit the asset account, which means going on the credit side, putting in the amount, and in this case, putting in what was bought, a motor vehicle. Right, so you see we have a debit to motor vehicle and a credit to bank. Oops, sorry, credit to bank. So we're going to go here now and we're going to put that in. Now, when you are entering information in your general journal, there's a protocol to follow. The debit entry or entries must always come before the credit entry or entries. So here, we're going to put the motor vehicle and we're going to put that debit figure here. Sorry, we're going to put the 50,000 figure under the debit column. And then, of course, we put our credit entry, and the credit goes to bank for the amount of $50,000. Now notice that there's a space, and now when you guys drop your general journal, you're probably not going to have all these different lines and cells. You may have some of those, but usually there's no line here, right, to separate these two things. So, but I put it there to kind of emphasize the fact that we need to indent the credit entry, right? We need to shift it across relative to the debit entry to make reading it a bit easier, okay? And of course, there's a narration. So the narration says to correct an error of omission. So a narration or a narrative is a very short explanation of the transaction you are recording above. It doesn't have to be paragraphs long, it doesn't have to be too long, but it has to be concise and give a description of what was above, okay? Right, so what we're going to do now, ladies and gents, is I'm going to scroll down, and I'm just going to have to shift across something here. So I'm giving you all 2 questions to try. So I hope you guys got your pen and your paper to try these questions. So I would invite you to take a pause of the video. Let me just shift across here. So pause the video, try those questions, and then unpause. All right, did you try those questions? Okay, let's take a look at them. So number 1 says, the payment of $4,000 to a creditor you owe me by check was omitted from the books. So we have an error of omission. Trial balance is still balanced, but we need to fix it. How do you fix an error of omission? You enter the transaction as it should have been entered. Okay, let's analyze. So we paid $4,000 to a creditor you owe me by check. So let's talk about paying money to a creditor. Who is a creditor? A creditor is somebody to whom you owe money for some purpose. Let's say you bought goods on credit from you owe me. Okay, that means you owe me, the money owed to you owe me is a liability. And if you pay off piece of a liability, it goes down, the liability decreases. Imagine you owed me $10 and you paid me back $9, now you owe me $1. So your liability has decreased. So let's go up here. So liabilities decrease with debits. So imagine we had these T accounts here and we paid $4,000 to you owe me. That'll go on the debit side and it came from bank. Now it says it paid by check, and that's why I said bank, right? So bank is an asset. And if we're paying money out of the bank to someone, it means the asset of bank is decreasing. So assets decrease with credits. So in the assets account, you're going to go on the credit side, you're going to put the amount of money, and you're going to put to whom it was paid. Creditor you.owe me. Cool. Right. So now when we come here, the debit goes to you owe me. So creditor, all right, you.owe me, and that's $4,000. And the credit goes to bank for the same $4,000. And this is to correct, an error of omission. There you go. All right, did you try the second one? If you didn't try it, pause it now and try. Okay, let's take a look. So it says, the receipt of $700 in cash from a debtor I owe you was omitted from the books. So we have an error of omission. Okay, cool. How do we fix it? We enter the transaction as it should have been entered. Okay, so the receipt of $700 in cash. So that means we received $700 in cash. The receipt of cash means we have received cash. Okay, how do we classify cash? Cash is an asset. If we receive cash, is it increasing or decreasing? It's increasing, okay. And how do we record assets increasing? With debits. So we're going to go, let me scroll across here. Do I have those? Yeah, yep, there you go. I got them. So we're going to put 700 on the debit side, and we need to put from whom or from where it came. And it came from the debtor, right? I.owe you, right? So we kind of see, hold on. So before I go off into, let me finish here, right? So the debtor, so a debtor is someone, a debtor is an amount of money owed to you, right? And a debtor is someone who owes you money. So that's an asset. And if the person pays you back, they now owe you less money. So your asset has decreased. So to record a decrease in an asset, that's the other column. So assets decrease with credits. right? So we're going to put 700 here, and we're going to put, oops, right? We're going to put cash, right? Now we could also, like I said, we could apply the hack, credit where it's coming from, debit where it's going. So we got money from the debtor IOU. So money is coming from the debtor. So we credit where it's coming from. Where is it going? We received cash, so it's going in our cash account. So you debit where it's going. So you credit where it's coming from, debit where it's going. So let's enter that in the general journal. So we are going to debit cash for 700. Oops. And we're going to credit the debtor I.OU. Sorry, right? 700. And to correct an error of omission. There you go. Okay, guys. So I hope you guys are trying the questions as we go along. Even if you make mistakes, guys, that's okay. We're trying things, new things. Mistakes are part of the process. All right. Just give me a couple of seconds. Let me rearrange some stuff. And we're going to get in the second type of error for today. Okay, so this is the second type of error, which is called an error of commission. So we're going to see the name here, right? And an error of commission is where a transaction was entered in the wrong person's account. Ooh, all right. And to correct this error, we have to remove the transaction from the incorrect account and put it in the correct account. Actually, I need to put this in quotation marks because we're not actually technically taking it out per se, but you will see what I'm talking about before, when I'm explaining it, right? Before I go into a whole thing where we talk in the air and I'm going to cut this whole part out. I hope, Chris, please cut it out. If I didn't cut it out, let me know in the comments. I'd have fired the editor. All right, cool. So, like I was saying, so we have an example too. So it says a credit sale made to a man was entered in a can's account. Okay, so a credit sale will require a debit to the debtor and a credit to the sales account. So you see here where it says it was entered, a credit sale made to man was entered in can's account. It means that the error was on the side of the debtor's account. So the sales account was credited, that's fine, right? So you are expected to know that. If you don't, you need to practice a little more, but we'll get some practice in here, don't worry about it, all right? So instead of debiting man, we debited can. So there's right now, there's a debit in can's account, right? That shouldn't be there. So how do we remove that? Well, the thing is we don't actually go and cross it out or delete it or white it out or whatever. We have to use double entry to remove it. So if there's a debit that shouldn't be there, how do we remove it? Using double entry? We do the opposite. We have to go on the opposite side of the account, which is the credit side, right? And enter an amount, the same amount, to kind of counterbalance it, all right? Now, what other account is affected? I mean, we're not going to go and undo the entry in sale. That doesn't make sense. It's correct there, all right? Where was it supposed to go? It was supposed to go to man's account, a man's account, and we were supposed to debit it there. So look at that. We actually have a debit entry here, right, and a credit entry here, and those two correspond. That actually shows the transfer of 700 from a can to a man. So we're going to put here a man, right, and we're going to put here a can. So let's put that in, right? So we have a debit to a man because that is where the debit was supposed to go in the first place, and we have a credit to a can because the money was the debit went there and it wasn't supposed to go there, so we have to undebit it. All right, and of course we put a very simple narration to correct an error of commission. Okay, so let's try some questions. I'm going to give you guys a couple of questions to try. Let's straighten it up here so you guys can see it clearly. Right. So what I would invite you to do now is to pause and try the questions and then unpause. Okay. All right, so seeing as you have unpaused, I'm just getting my T accounts lined up so you could see T accounts, right? Now, when you guys are doing it, like I said, you don't have to use T accounts. If you find the T accounts help you to visualize and understand what's going on, by all means use them. Okay, so the payment of $3,000 to B. Lam, a creditor, by check was entered in the account of B. Ham. So we paid a creditor. Now we saw something like this in the previous set of exercises. If we paid a creditor, so a creditor is a liability. And if you're paying a liability, as in you're paying money towards the liability, you are decreasing the liability. Because, like I say, if you owed me $10 and you paid me $9, you now owe me less. So you're paying off a liability, it's decreasing, which will require a debit to the liability. Now, we were supposed to debit B. Lam because we paid B. Lam, but it was entered in B. Ham's account. So there's a debit in B. Ham's account of $3,000, right? And it came from bank because we pay with a check. But this shouldn't be here. How do you undo a debit that shouldn't be there? You have to go on the opposite side and put an amount and put the same amount that to cancel it off, right? Now, where is that going? Because this is a credit, and every credit needs a corresponding debit. Where is the debit? Well, what was the account that was supposed to be debited in the first place? That was B Lam, right? So we're going to go in B Lam's account, put the 3,000 there, and we're going to put where it came from, right? So it came from creditor, B Ham. And up here now, this is where it's transferring from. So we need to put in the details column. Where is it going? So it's going to creditor B.lamb. Right, okay. So the debit went to B.lamb. So creditor B.lamb. Right, how much is it? It was 3,000. And it came from B Ham. Creditor. Ham. Right, so to correct error 4, commission. All right, so that's the first item there. All right, so here now we have question 2B. So a credit purchase of 2,500 from Corey Duck was entered in Stu Duck's personal account. So if we purchased goods from a creditor, we now owe them more money, because when you buy goods on credit, you didn't pay for them. You promised to pay for them in the future, hence you owe money for them. So your liability is either, well, it's increasing. Regardless of which way you explain it, the liability is increasing. So we were supposed to credit Corey Duck, but it was entered in error in Stu Duck's account. So in Stu Duck, we have a 2,500 that shouldn't be there, and this says purchases. So we have to remove a credit. So just now, when we had to remove a debit, we went on the credit side to counterbalance it. So if you have a credit in a place it shouldn't be, how do you fix that? You have to go on the opposite side, which is the debit side, and enter the same amount, right? Now, this debit here needs a credit. What account do we credit? Well, this was the account where we put the 2,500, and it shouldn't have been there. So this debit entry cancels that. What account should have been credited? Corey Duck. All right. So we're going to go in Corey, and we're going to put 2,500 because that is where it was supposed to go in the first place. And this debit and this credit are corresponding entries, and every credit needs a debit and vice versa. So we have to put where this came from now. All right, so it came from creditor, Stu Duck. And up here now, creditor, right, Corey Duck. Right, now before we go any further, I want to just point out here, this is an instance in error correction where the little hack we have, credit where it's coming from, debit where it's going, where it doesn't work, right? Because technically we're transferring value from Stu to Corey, right? But the thing is, it's actually a correction of an error, which is not typical double entry transaction recording. It's reversals in some case, and yes, correcting entries in some cases. So like I said, don't rely too much on that hack credit where it's coming from, debit where it's going, especially in error correction. Walk yourself through what's happening, how do I need to remove this item from there, and when I put it where it's supposed to be, where was it supposed to be put in the first place, right? So you need to ask yourself questions as you go along. The answers will come if you ask the questions. If you can't figure out the answers, ask me, ask your friends, ask your teacher. Somebody must know. Okay, so let's put it here now. So we had to debit creditor Stu Duck for 2,500, and then creditor Corey Duck was supposed to be credited and is credited now. Right, so to correct error of commission. Right, so again, if anybody has any questions, please feel free to let me know. So right now, I'm going to do one more type of error because this is almost going to go to about half an hour, all right? So I don't want it to go on too long. And with that being said, give me a couple of seconds, let me rearrange some stuff, and I'll be back. Okay guys, so for the third and final type of error for this video, we are going to take a look at an error of principle. So the note says that an error of principle, oops, a little too high, right. So an error of principle is where a transaction was entered in the wrong class of account, and wrong class means wrong type. The example will help us to see what I mean by that. So the payment of motor expenses, $500 by check, was entered in the motor vehicles account. So motor vehicles is an asset account. Motor expenses is an expense account. Now, yes, I did say at the start of the video, we spend money on assets and we spend money on expenses, but assets and expenses are different things. Assets are such things like furniture and fittings, as we said, equipment, maybe machinery, vehicles, that kind of stuff. We end up with something tangible that we own and we can use over a long period of time. Expenses are usually relatively temporary. Even if you prepay something for a year, right, non-current assets like furniture, vehicles, equipment, fixtures and fittings, that kind of stuff last for longer than 1 year. So an expense and an asset are not the same thing, although we spend money on both of them, okay? So we have motor expenses, that should go in the motor expenses account. So we were supposed to debit. Remember what I said? If an expense, if you're spending money on the expense, you're incurring it, you're paying it, so therefore it's increasing, we're supposed to debit that. So you debit motor expenses. But it was entered in motor vehicles instead. So motor vehicles will have a 500 and it will say bank because we paid it with a check. It's a check, right? Check. Now this is a debit that should not be there. How do we get rid of that? By going on the opposite side, entering the amount that we have to remove and sending it to the account it should have been sent to. What account was that? That was motor expenses. And in the motor expenses, now it should have been debited, but wasn't. So we have to debit it, as we are doing here. And we are showing the, I guess you can say the transfer from the motor vehicles account. All right, so the debit went to motor, sorry, I need to scroll down a bit more. Right, so we need to go here, right? So we're supposed to debit motor expenses, and we credit motor vehicles, and this is to correct an error of principle. Okay, so with that being said, let's scroll down and take a look at a couple of questions for you all to try. So let's scroll across to make sure it's in the center. All right, so let me scroll across here. So what I'd invite you to do now is I'd invite you to pause the video, try these questions, and then unpause. All right, let's take a look. So we have the payment of 800 for building repairs was entered in the building account. So this is very, very similar to what we did just now. So we had repairs to the building, which is an expense, as opposed to the building itself, which is an asset. So we were supposed to debit the repairs account, but we debited building. So there's an 800 item here that now we didn't see how we paid it. Oops, that was an error on my part. So let's put cash/bank, or you can put cash book or just bank, right? Seeing as I think I was supposed to put all payments via check in this entire handout. So this debit shouldn't be there. How do we get rid of that? Well, we have to go on the opposite side, put the amount we want to remove, and then put where we are sending it. So we are sending it to building repairs. Repaired, right. So building repairs, and it was supposed to go here in the first place as a debit, and it's coming from the building at cost account. Right, so we debit in building repairs and credit in building at cost. So debit, right, whoops, come on man, fill it. Building repairs, or building repairs, yeah. That was how much? 800, and credit building at cost as the asset account. And this is to correct an error of principle. I think I have to go and practice my typing. I'm a little rusty, clearly. I don't understand why, but okay. Okay, so for the next one, item 3B, the purchase of new equipment valued at $3,500 was entered in the stationery account. So this is kind of like the reverse. We bought an asset, we bought equipment, and if you buy equipment, it's increasing. So the asset was increasing, you were supposed to debit, but we debited stationery. All right, so stationery has a debit, $3,500, that shouldn't be there. We'll put cash/bank again. So how do we remove a debit that shouldn't be there? We have to go on the opposite side, the credit side, put the amount that needs to be removed and put where we're sending it to, right? It's supposed to go to the equipment account. And the equipment account was supposed to be debited in the first place and it wasn't, so we fix it by doing that. And we put where the transfer is coming from. All right, so these two items here correspond. This debit and this credit correspond. All right, so we're supposed to debit equipment at cost. That's $3,500, and we credit in stationery to remove the item that was put there. All right, so to correct, sorry, An error of principally. Cool. Okay, all right, so as promised, I was just doing 3 errors in this particular video, so let me do a very, very brief outro now. Okay guys, so that's it for this video. Thanks very much for watching. If you want to check out another video, be sure to click on one of those 2 boxes on that side. Don't forget to subscribe as well. Wait, they put it over my face, didn't they? And don't forget to check out the website. Click on that button across it to get the handouts. Anyway guys, thanks for watching. I'll see you next time. Bye.